Welcome to the fourth workshop in Guilford County's Summit Financial Wellness Series, Healthy Finances. My name is Lindy Fuller. I'm presenting today along with a distinguished panel of industry experts in order to help each of you make healthy financial choices. So today, my colleagues and I will be discussing how part of making healthy financial choices includes building your savings, protecting your financial assets with insurance, the raise, lower, and eliminate initiative, how to avoid credit pitfalls, managing credit strategically, qualifying for a mortgage, and smart investment and retirement planning. So we have a full deck of topics to discuss today. So building a savings program is part of basic financial nutrition. Experts say that we should have a minimum of 3 to 6 months of our annual gross income as an emergency fund. If we pay ourselves first using direct deposit to put a fixed portion of funds into savings each payday, we can build a savings with little to no financial pain. That sounds good to me. I don't like financial pain. Regular and special savings are an ideal place to start to maintain that emergency fund deposit. But there's also Christmas Club, which is a way to save for the holidays, and it earns a little bit more than a regular savings. And those funds are deposited year-round, but only withdrawn the last 3 months of the year. Now, money market allows for higher dividend earnings even when you plan to keep a minimum balance of $1,000, while the money market investor earns more for minimum balances of $10,000, while still retaining some liquidity of your funds. Now, certificates, they start at $500 minimum balance, while the jumbo certificates start at $10,000. These have more dividend earnings than regular savings, but have less liquidity, holding funds for anywhere from 6 to 36 months. And kids can save with our Kids Club. This gives earning age-appropriate prizes to kids on their birthday. We offer coin machines, Taste of Reality workshops, and Zogo, an app designed to educate kids of all ages and to earn gift cards that they can cash in, all while learning about financial responsibility. Moving on from basic nutrition to our dietary supplements. Now, protecting your financial assets is like taking your vitamins. Rather than maintaining your physical health, though, this protection builds immunity from paying losses associated with our vehicles and our homes being hurt. At Summit Credit Union, we have partnered with the Needham Group Incorporated to provide a full suite of affordable insurance solutions. Vicki Hill is our in-house associate insurance agent. Vicki, how can you provide insurance solutions?
Good morning, everybody. I hope you're all doing well. It's my job as an insurance agent to provide a plan of insurance that's designed for your specific needs to protect your assets and your investments. So we have lots of different carriers that we can contact as far as your insurance for your auto, your home, and not only that, your toys, your boats, your motorcycles, your RVs. We also do commercial. Some of those companies are Nationwide, Allstate, Travelers, Liberty Mutual. So we do have quite a few options for you if we need to use any of those. We have competitive options. We have lots of discounts and credits that can be applied to get you the plan that you need. We also have the option to review your current program, just to go over your coverages, to make sure that you have what you need, to make sure that your coverages are enough, to go over your deductibles, just whatever it is that you may need at the time. So whenever you're ready, contact me either by email, text, give me a call, or come by the office. I'll be happy to help you.
Thank you, Vicki.
You're welcome.
At the end of the presentation, we'll share all of Vicki's information so that you can contact her. And of course, you'll be able to ask her a bunch of questions at the end as well.
Thank you.
So our initiative to support healthy finances at Summit Credit Union is simple. We want to help you raise your credit score, lower your auto insurance and auto payment premiums, and we also want to eliminate your high interest debt. Everyone wants to raise their credit score. Why do you think that is? Well, higher scores equal lower payments or premiums, right? And some say some debt is good. Why is that? Well, if we establish or maintain our credit, it offsets low periods of cash flow. So let me give you some examples. First, a $500 line of credit backs up a checking, which can avoid non-sufficient funds fees and gives you some purchasing freedom. Two, you have, let's say, a $15,000 balance on your vehicle and 51 months left to pay on your car. That loan is at 7.5% at so-and-so bank. That's still a pretty good rate, but you're paying $350 a month. You could refinance that here at the credit union for 3.75 to be paid off in the same 51 months. And now you only have to pay $320. That's a savings of $30 a month, which has you paying a total of $1,530 less for that vehicle. I love saving. Third, our on-site insurance agent, Vicki, who just spoke with us, saves our members an average of $530 a year. So is it time to take your financial vitamins? You'll want to speak with her later. And you'll want to look into how our initiative could work for you to raise, lower, and eliminate. Next, we'll want to avoid credit pitfalls and save your credit score. Although consumer loans to be paid 30 plus days late is costly, how many points would you lose for being 30, 60, or 90 days past due? Any guesses? You can unmute and say it, or you can put it in the chat if you've got a good guess. Well, I'll help you out. It takes only moments to negatively impact your credit scores and years to recuperate what was lost. If you can't avoid being late, protect your score by paying no later than 29 days late. You say, well, I don't want to be late at all. Well, sometimes life happens and you have to be late. At least now you can think about how to be strategic if you can't avoid being late. That way, even if there's a late fee, you'll avoid paying credit score penalties for up to an additional 24 months. Fortunately, though, you can't lose more than 150 points for past due consumer loans at one time. That's a bonus. Now, home loans and collections have a little weightier score consequences. So unless there's an error to dispute, only time can heal these items on your credit score, or your report. Look at how they can detrimentally affect you. This is not including your consumer loans. So fortunately, the vast majority of these points is only going to hurt the first 24 months, and the heaviest weight is going to be in that first 6 months to a year. Is that shocking or surprising to anyone? Yeah. To me, it was a real eye-opener and helps me appreciate that as consumers, we can be strategic. Now, CSAs definitely promote healthy credit. I always say that knowledge is power. So when you know your score, you understand how to improve it, along with what to avoid, you can become healthier financially. The better that score, the better your loan rates, your home insurance premiums, all of that. Summit's member service call center can schedule a CSA at the branch, or you have the choice to reach out to me personally. I take care of all of our CSAs virtually. And I have helped many of our Guilford County employees. We've had a great time looking at how we can be strategic. Now, you can either raise your electronic hand or just give me a visual, but I would love to know if you've already done this, or if you'd like to share your experience on that. Put it in the chat or unmute briefly. Tell me, how do you feel about the CSA session if you've had one already? Any of you? Oh, you don't know what you're missing then.
Lindy, this is Laurie Jones. You actually completed a CSA with me, and it was one of the best things I've done in a while. I'm actually still working on making some disputes to my credit report that we found on there, and it was very helpful in teaching me ways that I can actually increase my credit score and how soon my credit score will actually increase if I continue to follow the plan that we made.
Yes. I'm so glad you were able to get on and share that today. Thank you. Anytime we can impact just one person with the benefits of that CSA, it makes everything worth it, you know, because that's life-changing. When your credit score goes up, so many things positively can happen. Your credit score is not affected negatively by doing a CSA. Thank you for that question. Ultimately, we do what's called a soft pull. So you will not experience a negative point reduction, but we do explain in that process what will in fact impact your score negatively. So definitely schedule one of those if you have not already, either in branch or with myself. Now we're going to hear from our area mortgage originator, Dirk Spainhour. He's going to discuss the steps to home ownership and how your credit matters, how to qualify for a mortgage, and understand mortgage specific terms. Dirk, you have our attention, sir.
Right, we're ready to go and making sure everybody can hear me. We've had a technical issue this morning, so I am wearing a headset. So first of all, understanding your credit. The big key in mortgages is to know what your score is and what kind of credit you have before you enter into any kind of contract or before you actually start looking. Right now, to get a fixed rate mortgage, you're going to need 640 and above on a credit score on all three bureaus, your Equifax, your Experian, and your TransUnion. So understanding your credit is a vital role in the pre-approval and pre-qualification process. When you drop below the 640 scores, you're looking at large down payments, and most of the time you're looking at adjustable rate loans. The computer scores that is generated through these for your credit, it predicts how you're going to pay, and that's why they look at it. And it has been used by these agencies now for about 20 years. And before it became public knowledge, they were actually using it secretly or quietly in order to help tell the investors that back these companies what the chances of the payback was. On the screen, you'll see that we do use, in the mortgage world, an Equifax, an Experian, and a TransUnion report. And these 3 reports basically cover all your lending companies nationwide. Scores range from 300 to 850. And again, as you go back to what I was saying earlier, FHA, you have 640 is the minimum score. And in what they call the conventional world, where you hear the Fannie Mae's and the Freddie Mac, they look for 660 and above. Now, I do want to tell you something that has come to our attention over the last several years. If you go on the internet and pull up FHA, they say they will go below 640 for credit scores. Now, there's a kind of a caveat to that that's not put on there. Number one, you have to have a large down payment. You have to have somewhere near 20% to get that loan or above. The second thing is that they require PMI insurance on those loans, even if you put that amount down. And the problem that they're seeing is that the insurance companies that back the loans will not go below 640. So even though they advertise it, those loans are almost impossible to get. I've done this for 28 years and never seeing them do a loan below those numbers. So I know they say it's out there, but I've not seen it. So when we're looking to qualify you, we're going to look at your credit, of course, but we're going to look at your income. We're going to look at the assets for your down payment and your closing. What do you have available? Your credit worthiness is basically going back to your credit score and how you pay your debts. The last 12 months, as far as your debts, we want to see how you've got, what you've gotten, and how long they've been there. If you've got 12 months reporting on your credit bureau and you've paid it well, that is a wonderful thing. The property, what type of property are you buying? Is it a house? Is it a townhouse? Is it a condo? Is it for investment purposes? Is it manufactured home? All that makes a difference in what your rate and your score or rate and your possible down payments are. The last thing is bankruptcy. We do want to talk about bankruptcy a little bit. If you file bankruptcy, you're looking at anywhere from about 3 years or longer before you can qualify for getting a new mortgage. And you want to make sure that you've reestablished your credit during that 3 years so that you're showing that, hey, I've went through it and I'm doing well. So those are the kind of things we look at for qualifying a mortgage. Lindy's another, there we go. Defining mortgage terms. Us, the individuals in the mortgage industry, sometimes we kind of get rolling and don't do a lot of explanations. But one of the big things that has become a major issue in the industry is the debt to income ratio. And what that typically is just your debt, your total monthly debt divided by your total monthly income. Income includes your salary, child support, alimony, second jobs, if you've been on both jobs concurrent for 2 full years. And then we take that and we look at your debts, which is car loans, student loans, minimum credit card payments, note loans or signature loans, your mortgage loan, any child support you're paying or alimony, items like that. We don't really care about utilities. We take the minimum payment and divide it by your income, and that determines what your number is. It should not exceed 43%. If you go over 43% of your gross monthly income on that ratio, you're not only are you going to have a difficult time getting approved, but if you do get approved, you're going to have a difficult time paying your bills. And we don't want to put you in a position where you're not able to pay bills. Another of our huge terms is loan to value or LTV. That is simply the loan amount divided by the value or the cost of the home. If you're buying a house, it'll be the loan amount divided by the value of the house or the purchase price, whichever is less. Sometimes, you're looking at, if they say, well, I can get you 95% LTV, then you're going to have to put 5% down on the purchase in order to get it. And also that amount also determines what your payment's going to be, because that's how we determine what your maximum loan amounts are. So that's what we look at. And that's some of probably the two biggest terms that you're going to hear the most as a buyer or someone that's refinancing a house. And we'll go to the next screen.
I think that's it.
That's it. Okay. All right,
Thank you for sharing your
Sure,
expertise.
could I ask you a question?
sure.
I think you mentioned this before, and I just wanted to bring it up. Do they count medical debt for qualifying for a home loan?
No, sir. Medical debts or medical collections are not calculated in that. But there is one that a lot of people do not understand. If you have student loans that are currently deferred, we have to count a minimum of 0.5% of the balance of each student loan that's deferred in determining a minimum payment amount. So even though they may be deferred, we do have to count it in your ratios. And a lot of people are not aware that the government stepped in and made that a regulation about 3 years ago.
Thank you. For all other questions, we like with Miss Vicky, the same with Dirk, we will give you an opportunity to ask all the questions as well as get their contact information if you want to schedule something either over the phone or in person with them, okay? Again, thank you, Dirk.
Yes, ma'am.
Now we'd like to introduce our on-site certified financial planner, that is Mark Lopresti, and he will review highlights of what he has to keep your finances healthy. Mark.
I'll make it brief. I know we all want to get to work, right? I just want to introduce what we do provide for our clients here at Summit. We do some comprehensive financial planning to help you weigh your goals against some actions, coming up with some actions that help you reach your goals. And it involves 40 areas of financial planning, which we do seamlessly behind the scenes, making it easy for you. But I want to give you some ideas this morning on how to improve your financial health so that you can reach more of your goals. And I'm going to outline 3 things that we see all the time with clients that probably apply to some of you so that you might get some ideas from this. What it will provide you is potential ways to change your budget so that you could then start to save and build more. And ultimately, I mean, one of the things I joke about, but I'm serious about, is I help people quit their jobs. I know employers don't want me to say that, but we all want to quit our jobs at some point, and I help people quit their jobs. So I want to give you some ideas on how to quit your job sooner. And here are 3 mistakes that I see repeatedly in financial planning here. So the first one is, we're all guilty of this probably, but oftentimes we want a shiny brand new car because it gives us a great feeling, and it's a status symbol, and also it's reliable, which of course we all want. And I just want to point out that doing a little just kitchen sink accounting, napkin accounting with a financial calculator, if you take a 20-year-old and they buy a luxury $45,000 car, which I've seen, versus buying a used $15,000 car, and let's just assume that they paid 4.9% interest, which is probably too high nowadays. We can get a much lower interest rate. I know we do here around Summit. And you finance that just for 5 years, which oftentimes many people finance for much longer than that. What you'll find is there's a difference of payments of around $564 a month. And if you took that investment, that money, and you invested it at a 7% growth rate, which many of you may not know, but if you're a conservative investor, maybe in your 401k plan or just in investments outside of retirement, that's an achievable goal. Most people have exceeded that for the last 10 years. What you'll find is that that single decision, avoiding an expensive car for a less desirable, maybe used car, allows a person that's 20 years old to save an additional $659,000 by the time they reach age 65. That's just simply taking the savings on that 5-year loan and investing it from age 20 on, or during the term of the loan, and then on after the loan's paid off. The difference, investing it, that's more than most people save for retirement. One used car versus one new car at a young age it gives you more ability to save than most people have actually saved by the time they reach retirement age. That's an eye-opener. That's an opportunity to save almost $700,000. I'm going to go to one that we all take near and dear to our hearts, and that is eating out lunch because we're stressed, we're at work, we're busy. We just want a little break. And so I did a little calculation. I'm saying this because I bring a lunch bag with me every day. And here's a common mistake. We go out to lunch every day, and we don't really count it in our budget. We don't think it's much money. Assuming that lunch just cost you $8.50, which, by the way, seems low to me. I know nowadays if you go to Panera for lunch, it's like $14. But assuming it's $8.50 versus the cost I've figured out of packing a lunch, $2.50, saves the average person $130 a month. If they were to take that savings and invest it from the time they're 20 years old till they're 65, that's an additional $492,000, assuming they can achieve a 7% growth rate again, a low conservative growth rate. That's another $500,000. I think you see where I'm going with this. We all are making decisions that are taking away our ability to save. I'm going to give you one last one. It's the house decision. We all have to make it at some point, and oftentimes we go too far. So I'm comparing someone that buys a $250,000 house, or mortgage anyway, with a $150,000 mortgage, and the difference of mortgage payments only accounting for principal and interest. I'm not counting insurance differences or any other insurances you might have to buy based on down payments, but just simply the loan difference. And I'm assuming that you have a 4.5% interest rate. We can actually get a lower rate these days than that. It's a wonderful thing. It's a good time to buy a house for that reason, but it's also driven up house prices. Anyway, that savings between a $250,000 mortgage and a $150,000 mortgage is somewhere around $760 a month. Again, if you did that for 30 years, from the age of 25, you'd find that by the time you're 65, that difference decision means you could not save $618,000 if you were able to achieve a 7% return. That's a massive amount of money. Those three examples are how a person can save $1.77 million in their lifetime. Just three simple decisions we all take for granted and never consider. These are examples of the kind of things we help you figure out to give you ideas on how to empower your retirement savings or other goal savings, and then ultimately to quit your job. That's it. My name is Mark Lopresti. If you ever want to discuss more detail about your personal financial planning, feel free to call us here at Summit. Thank you.
If you have questions or comments for our esteemed panel of experts, you can type it in the chat or raise your electronic hand to be called on and unmute so that everyone can benefit from your questions and their answers. You can also screenshot this information. That way you've got their faces with their contact information. Dirk, Vicki, and Mark are awesome to work with. I've worked with all three of them personally. Can't tell you enough about how passionate they are about what they do. Like myself, we love helping people save money and get better with their finances. So I'm going to open it up. If you all have a question or several things that you would like to comment on, feel free. Again, raise your hand or in the chat, and then you can unmute and we will address those. Dirk, I will start while everyone's thinking of their question. In this market, what are you finding is the most challenging thing to get people to closing?
The biggest thing in the mortgage market right now, Lindy, is what we call the turn times, from the time you apply to the time you close. And this is a nationwide issue. This is not just Summit Credit Union. Even your super big names that advertise all over the markets about how quick they are, they're hitting this because of several reasons. number one, we're in the lowest rate environment in the history of the United States. So we're seeing mortgage rates is lower than it's ever been. So you have everybody wanting to refinance, and then you got the people that's wanting to buy. And due to COVID and some other reasons, the appraisers that come out and value the house and send us the data, they're behind. The attorneys are behind because of they can't get the same number of individuals in their offices to sign on the loans. So instead of doing 12 to 14 closings a day, they're limited to 6 or 7. Like on a purchase, when you've got the seller that's got to come in and sign, they have to come in and do it first. You have to wait for them to clean the offices. And it's just really become a situation where it has bogged down the industry. So that's our single biggest challenge in today's world is just the timeframes. And whether you're talking to Summit Credit Union or any of the big name banks or the other financial institutions that do mortgage, I'm going to implore you on behalf of all of them, be patient with them. It's not that they don't want to close your loans. It's just there's a lot going on in the industry right now. So it's a good thing. I'm going to go ahead and answer one that just popped up. Construction loans. We do not do those. Unfortunately, there's very, very few lenders now that do construction loans. And the thing is you're probably talking about one of your big national banks is about the only ones that still do those. And I'm sorry, Lindy, I've lost some of those. So if some of those are for me, you can get back with me.
No, that's great. The next question is from Diamond. Do you think that it's a good time to buy a home? Because she wants to buy a home in February.
It is a good time. It's a good time because of rates. Now, I will caution you that with the rate environment and the shortage of available housing, home prices they're also where you're at all-time lows on the rates. Home prices are pretty much at all-time highs, and it is a seller's market. So, you're paying maximum amounts right now for homes. Not telling you not to buy, but if you find the home that you want and it's your dream home, I would not discourage you because you are getting it at a very cheap rate.
Thank you. Now, Vicki, let me ask you a question. When it comes to homeowners and vehicle coverage, would you say that bundling is always the best way to go?
With most companies, yes, because they do offer the home car discounts. So you're going to save a good percentage when you do the home and the auto with the same carrier. That's always a good idea. Yes.
Okay. Now, I know that when I purchased my home last year, I had you evaluate that situation. Now that it's been a year, would you recommend that I go ahead and get a new quote to be sure I'm getting the best deal still?
Yes, because things change just like with any other market. The insurance rates do change as well. So it's always a good thing when your renewal is coming up. Just give me a call and I'll be happy to look at it, quoting with other companies just to see how the rates compare with what you currently have. Yes, I'd be happy to do that.
All right, thank you. And so
You're
I know
welcome.
if she can do it for me, she can do it for you all.
Anybody.
Dirk, we had another question for you from Diamond. She says, is there any first-time buyers programs that you would suggest?
There is. There's several out there right now, and I'll tell you about the ones that Summit offer, and I'm also going to tell you about ones that's being run nationally that we don't have, but I'm going to tell you who's got them. All right. Right now, Summit has 3 first-time home buyer programs. 2 of those require 3% of the sales price as down payment instead of 5%. And then the third one requires 3.5%. One of them's Home Possible, one of them's called Home One, and one of them is a FHA loan. And those are all great loans. Right now in Guilford and Forsyth County, there is a program that's out that is called a down payment assistance loan. Those loans are run through a group. There's quite a few lenders that'll do it, but the one that I have seen to be the most reputable is a group called Movement Mortgage. And what it is it requires 3%, but you take a class and they give you the 3%. So, we've sent some people that way because it's basically a no down payment loan. So you're getting into the house with no cost. You do have to take a class, you do have to pass the class, and it does have to be within certain guidelines here in Guilford and Forsyth counties. Also, there is a lot of regulations on that loan about how much money you can make per person in the household. There is a limit on the size of the house you can buy. So it's not for everyone, but it is a good loan. And those are really the biggest first-time homebuyer stuff that's out there right now.
Do you see Ebony's question?
I did not, I'm sorry.
That's okay. It says, how long do you think the entire process takes to becoming a homeowner, from applying for a loan, finding a house, etc., to closing?
When you apply, it's going to take 2 to 3 days to get your answer back. Once you get the answer, you'll get your approval letter. And that's what the realtors and the sellers want to see, is that you're approved. Once you start looking for the house, I can't say what it's going to be as far as timeframes to finding what you're looking for. It is a little bit longer than it has been because there's such a limited market. But once you find that house and you go under contract, you're looking at about 45 days at this time from when you sign the contract to the day you close. That's a little bit longer than in the past because of everything I was mentioning earlier. But usually about 45 days on a purchase is about normal, what we're seeing in today's market.
All right, thank you. Are there any other questions for our panel of experts? One of the things, and you can still, while I'm talking, type away or raise your electronic hand. I will go ahead and let you know that if you are interested in a virtual credit score analysis and want to establish membership, if you're not a member with us already, you can contact me. I can take care of both of those things. Also, we do have another question. Dirk, they want to know about USDA loans and ballpark on how much one should have money-wise before buying a home.
Okay, I'll address the USDA question first. USDA is a great loan. It is a government-backed loan. There is no down payment required on a USDA loan. There is a catch on some of those. Some companies that do USDA loans, their loans have what is called a recapture fee, which means that if you sell or refinance that house within a specified amount of time, you have to pay a larger portion back. So with that being said, I saw one recently that had a recapture or a subsidy fee that equaled $18,000. So they were going to do a refinance and they could not do their refinance because of where it put them. So you got to be very careful on USDA loans. You got to make sure that when you're talking to your representative that they're getting you the USDA loan that does not have a recapture or a subsidy. Summit Credit Union USDA loans does not have a subsidy or recapture. Now, also USDA, you cannot be in a city environment. It is a rural housing loan. So they want you outside of city limits. Very, very little, if anything, still meets those requirements in Guilford County. I have seen some recently pop back up that qualified, but not very much. So I hope that answers that portion of USDA. And then I want to address how much you should have down. It depends on what you want, the size you want to have. I suggest at least $10,000 because if you buy $100,000 home and you put 3% down, you're looking at closing costs, because most sellers right now are not paying closing costs, of another 3 to 3.5%. So on $100,000, you're already into it for about $6,500, $6,600 or more. So in today's market, the housing market, you're probably looking realistically in Guilford County, Forsyth County, Randolph, Rockingham, to get a decent, a home that you really want to sink your teeth into. You're probably looking at needing $120,000 to $150,000 loan. So you're right at $10,000 to $11,000, $12,000. So the more you can put together, the better off you are.
All right, thank you, Dirk. Now, we're going to come back to you in just a minute, but we've got several more questions. Vicky, Mr. Bumpus wants to know, should I notify my insurance agent of my credit score to have my premiums decreased?
That would be a good idea because most insurance companies do not pull credit reports at each renewal. So if you do have an improvement in your score just prior to your renewal, if you would contact your insurance carrier, they would look at that and possibly decrease the premium. So yes, that's a good idea.
Oh, thank you for that question. And I love
Thank
hearing
you.
that. I didn't know that myself.
Yes.
Mark, we have a question for you as well. How would you determine if you
Yeah, I
have
saw that.
enough in investments to retire early?
Yep, that's actually an excellent question that's really hard to answer, but I'm going to try and summarize it easily. You have two concerns. The first one is, do you have the right kind of money? All money is green, but some money has penalties. So if you have all of your money in a retirement plan, like a 401k or a traditional IRA, even a Roth IRA that you haven't held for 5 years, there are penalties to accessing that money, which may limit your ability to retire early. Now, there are also exception rules to those penalties that involve a much more structured, planned out source of income that you cannot change. So there are exceptions that let you draw early from retirement dollars, but you have to follow a structure that you don't change for 5 years. Even though you might be over age 59 and a half, it gets really complicated, and you better do some planning in advance to structure your finances into multiple buckets in case you do need to access additional money. You don't want to disrupt one of these plans midway. I've helped many of our members retire early using these things, but it involves a little know-how. It involves some tax sophistication. Oftentimes you're going to have to find a CPA that knows how to do it too, because most do not or don't know that they should be doing it, and then it gets ignored. I can help you with all of that and solving those problems. The second thing is, how much money does it take? Remember, if you retire early, you're retiring longer. So you need a little more money, or you need to draw a little less from it to make it last longer. And then ultimately, that's just doing some really good calculating of what's an expected growth rate that's achievable while you're drawing out income. And oftentimes people miss pieces of that puzzle. So for example, when I'm 20 and I'm super aggressive, I grow at a certain rate. But if I'm 65 or 60 or 55 and I'm drawing out income from that money, I better not be doing the same kind of investing that I did when I was 20, because the minute there's a market downturn, I'm assuming you're a risk taker here, the minute there's a market downturn, that would then fail as a plan. To give you an example, back in 1999, many investors were having great returns and they retired. And ultimately, they followed a strategy that was very popular back then, which was to just invest all your money in the S&P 500 because it was growing like gangbusters, and no one saw any risk. 15 years later, those same retirees went back to work because they ran out of money. That's an example of an investment strategy that does not stand the test of drawing income out, which you might also make as a mistake. So there's a lot of consideration to retiring early or just retiring on time that have to do with knowing how to invest, how investments change when you're in your income phase versus your building phase, and then ultimately having buckets of money that can handle early retirement, to your question. If you've got questions about that and you want to know a little more, let's meet. I don't want to give too much specific information on this presentation because unfortunately, I'll give you part of the information and then you'll go and take it and maybe misapply it. And I want to make sure you apply it with complete knowledge. So that's something you should definitely see a certified financial planner for.
Thank you for that question, Carrie, and that answer, Mark. We got one last question for you, Dirk. It's from Lisa. If you already have a home and it's paid off, now you want a second home. Are there any second home deals like the first time home buyers?
Unfortunately, no. They pull, in today's world, we're required to pull something called a data verify that basically gives us a lot of information about an individual. And it lets us know if you already own a home, if you already, if you paid one off. So if you are buying a second home, you're looking at about 15 to 20% down for a second home. And I'm talking beach property, a mountain house, something like that. If you're buying something that is not in a resort or retirement type situation, you are looking at a minimum of 20% down. And if you try to tell, hey, I'm moving to it, it's got to be something that is feasible. You can't own a home that's worth $250,000 and buy $100,000 house and say I'm moving to it, and it's in a downtown of a local city. They do check up on us and make sure we're doing everything on the up and up through those reports. So there's not really a first time home buyer out there for something like that. Now, if you own the house and you sell the house and you do not own a home or be on the deed of a home for 3 or more years, you can qualify for first time home buyer programs.
Thank you, Dirk. So what I would like to say now is, as a part of the Guilford County Summit Financial Wellness Series, Dirk will be speaking on home buying and refinancing during our November series, and Mark will be speaking on Social Security and retirement during December. So there's another opportunity for you to get a little more specific information, to ask even more questions and dig deeper into those specific needs. We certainly hope that you got enough information and appreciated what we had to share today in reference to healthy finances. Thank you for your time and your participation. We're all resources for you and would be happy to help you reach all of your financial goals as soon as possible.